we've got a question from Lynn. And Lynn says, what is the advantage to short options, 1 to 5 days? Okay, well, let's just take Amazon right now. We're going to illustrate a few points to discuss the advantages of shorter term options that we look at as options investors, selling usually shorter term options, and some of the cons of those that might come back over time to haunt you. But let's just go to the chain for Amazon. We're going to keep it simple and just look at a call chain. And we're going to go 14 days out in time, Lynn. So, oh no, you said 0 to 5, but 1 to 5. So let's go for next week. And I'm going to go ahead and hold those numbers. And let's see, what's a good range here? 42 is good. That's 6 times the amount of time. We'll go to the April 14th weekly series. All right, now, some of the things that you see here on our chain, these shaded columns that we have in this area, Lynn, this is showing us, okay, sorry, selecting a pen color. This is showing us the percent return if unchanged, the percent if assigned, percent naked yield. As in, if this is done as a covered call, we can see the downside protection, percent if unchanged, percent if assigned, percent naked yield. And of course, also the midpoint time value is also important. That's relative to the percent naked yield. All right, so let's just focus on that midpoint time value, the percentage midpoint time value in. The at the money, where were we here? We're pretty sure we're at the money at that strike. Oh, 94.90. My apologies. The 95 is the at the money strike, the closest to that price. And we see here for 7 days of time right now, we have 1.8% of time value in the at the money option. Of course, at the money bell curve, you can see here, that's the at the money option is always the highest time value. As you go deeper in the money, the time value decays. As you go out of the money, it decays as well. The price is higher, but that's mostly intrinsic. But here we are at 1.8% time premium. If we sell into that option for 7 days, we generate 1.8% in. The advantage of shorter term options is they're always going to have a higher annualized return naturally. What we mean by that is the option that is 6 times the amount out of time will not be 6 times the time value 95, 98% of the time. There are some outliers that occur from time to time, but in general, the time value is 6 times the amount out in time, whether you're comparing a monthly to 6 months out, Lynn, or 1 to 5 day out, for example, versus 42 days out, as we're going to see in a moment. The time value premium that you're collecting in these cases is not 6-fold. So let's just take a look at our 95 strike for that April 14th series, 42 days away, which is 6 times the amount of time. It's only at 4.9%. So in theory, you see the beauty of this and the advantage of this, that if I'm able to sell week by week by week, now sure, on Monday it's probably going to be down. If the stock even stays at 94.90, this will drop maybe to 1.5, maybe 1.6. We're going to lose some time value for the next 2 days of decay. It might be as low as 1.3% for only a 5-day trade. However, if I'm able to sell every 5 days out and generate 1.8%, I do that for 6 weeks, we're going to be over a 10% return, aren't we? It's going to be about 10.8% if I did my math right, as opposed to 4.9% in time premium for selling the 6 times the amount out of time. Is the premium higher? Absolutely. 468 midpoint versus 171. Is it 6 times the amount of time? No. That's the advantage. Even before the weeklies came out, Lynn, that's what investors would look at. Most people who are doing covered calls, cash secured, naked put, or credit spreads would focus on the 30 to 40 day out options. They wouldn't do the 90 to 100 day out options because that's too much time for the trade to potentially move against you. But you're also damaging your annualized return by selling further out in time. 2 weeks, 3 weeks, 5 weeks, or 6 weeks. Another obvious advantage, now let me leave that on hold here. Another obvious advantage, as you can speculate, is that if I did a covered call, or I did even a credit spread 1 week out in time, which I'm going to increase my annualized return in theory, not including management, things going against you and stuff of that nature. But now I have a wide range of choices if a trade does move against me. I could potentially just go out to the next week. I could go to the 2-week out option, which today would be 21 days away. We could go to the March 31st, 4 weeks out. We could go to the April 14th to help manage a position, try to roll for a credit in a covered call or cash secured naked put, try to manage for a profit in maybe a bull put or a bear call credit spread that moved against us, or a debit spread. We have more choices to roll and to adjust. Whereas if I sold the 42-day out series and it went against me, I might have to go out 77 days, 105 days, 140 days to try to repair the position. Now, if I collect 1.8% in time premium here, an example, say with a covered call, Lynn, versus 2.8%, oh, that's not a bad comparison really, but that 4.2, 4.3% we saw for 6 times the amount of time, and the stock falls 5%, well, technically, I might only be at a 0.2, 0.3% loss on my covered call selling the 42-day out option, whereas here we'd be down, what, 3.2%. We know we're collecting less up front when doing the 1 to 5 days out, so our triggers might be set a little bit differently. In other words, my percent to break even is not going to be as low or as high, depending on the strategy you're doing. I don't have as much room before the position hits to break even. So this is going to be have to be monitored a little bit closer, Lynn, than maybe selling something that's 30 days out in time with extra premium and a little bit extra hedge. You maybe find yourself managing more often and rolling these positions if it doesn't work out the way you expect. Okay? But there's distinct advantage to these trades. Using the weekly series, using the shorter term is usually the preference that Ernie and I suggest to our customers on coaching sessions looking to do adjustments for covered calls, cash secured naked puts. My preferred bull put credit spreads are 8 to 14 days out in time. Same with potentially the bear call credit spreads. That's the default weekly bull put credit spread and weekly bear call credit spread in those strategies and power options. And for covered calls and naked puts, of course, we do have a monthly picks of the day for those who like a little bit more protection, a little bit more premium and time value to help the downside protection of the covered call, but also the weekly picks of the day for that shorter term, better annualized trade. Also, you'll see that in the naked puts as well. So, main advantage, you're going to increase your annualized percentage return. You're going to have more opportunities and selections, I should say, to be able to roll and adjust a position if it starts to move against you. The cons of it, you take a little bit less premium up front, so you don't have as much of a hedge when selling, and you may have to be managing, adjusting, or moving more frequently due to the short time frame and what we've seen as recent bursts in the shorter time frames, Lynn, in the stock market as well. One thing I never really suggest, and I've never been successful with myself, different tests, paper trades, back testing, and so forth, is a consistent way to profit buying weekly options 1 to 5 days away, whether they're calls or whether they're puts, even around earnings. It's been difficult at times to manage those. You pay a lower price, and that's great. But your time decay is working so quickly against you that you need that move and you need to happen soon in order to get the potential profit that you want. I know there are investors that do this successfully. I know there are investors that do this with a smaller portion of their portfolio. But then again, we talk about the opposite idea. That concept, the main underlying concept that we talked about with options investing, when I'm selling, I want to sell shorter term, week by week or month by month, as opposed to selling something that's 3 months out or 6 months out in time, because I can theoretically get a higher annualized return. Even though I'm collecting more premium 6 months out, it's not 6 times the cost of the 1 month out. In reverse, if I'm playing weekly options and I'm buying for quick profit, which could be 40, 50, 80%, maybe higher, absolutely higher with some movements, but in theory, I'm paying into a higher time value and will have a higher annualized cost over time. That's why when typically you go into our long call or long put searches, I just have long puts here, you'll see the default searches are usually set to be 75 to 150 days out in time rather than looking at the weekly series. Weekly series are preferred for selling, in our opinion. Doesn't mean we're always right. But those weekly series for selling to maximize the annualized return, Lynn, have more opportunities to roll and adjustments to do as well. And buying those positions, buying weekly options, I've never been successful with. Had a good hit here or there in that case. I know some investors that have. Richard says, so with the shorter duration, you have to be very sure of the trend when selling options. Well, I'd want to be sure of the trend, Richard, if I'm selling 14 days out, 20 days out, or 30 days out. I'm one of those ones that tends to follow the trend until the trend ends, so to speak. I'll talk about that a little bit more when I get to Sergio's question after some of the other live questions that came in related to the MACD. But yes, whether you're doing shorter duration, you want to make sure. But again, what we talked about here, let's go to the covered call position. And I'm sorry, let's go into the search real quick. There we go. And, just looking at the weekly picks of the day, you know that you can set your options criteria for time frame. This is our default search that I mentioned. But we're looking for stocks that are trading above their 20-day moving average and where the MACD has been above, the signal line has been above the EMA 9 for at least 1 day. All right, so what essentially does that look like? Let's take a look at Sunrun, and we'll go to the charts here. So this is waffling a little bit. This isn't as good as the other one we're probably going to see in the bull put credit spreads. But you see we're starting to have a positive MACD crossover. The RSI is coming up off of a bottom. I'll scroll down for that later. It did just move up above the SMA 20, but the last 5 days with a little hiccup here, it's been sort of in an uptrend. Now, we could say it's been in a decline for 14 days, but that's something that you could set there as well. I could tell the system, hey, maybe I want it to be above the 50-day moving average, or stocks where the 20-day is above the 50-day, for example. But yes, you don't just, one of the powers of power options is we're not just looking for positions that have the highest premium and the best return. We're looking for those positions that have the highest premium and the best return, along with what we feel and have tested are the criteria that give us the best opportunity over time to see consistent profits on a regular basis. Okay, so this is the weekly picks of the day. The monthly picks of the day is about 75 to 80 different iterations of stock criteria, option criteria, and others that Ernie did. Best foot forward, so to speak, of what worked over time. You check the weekly picks of the day. And then you can click see how we developed these results, and it goes through Ernie's discussion of what he did. And absolutely, technicals, you want liquidity needs filled, shares 500,000 per day. You can even go up to 1 million if you wanted to. Stocks above the SMA 20, positive MACD signal. For the bull put credit spreads, essentially the same thing. I'm looking for a MACD that's greater than 3 days. The 1226 has been above the EMA 9 for at least 3 days, with stocks above the SMA 20 as well. And those are 8 to 14 days out in time, as I mentioned. Same thing for the naked put. We just go to the search, and I want something that matches that trend. Stock above the SMA 20, avoiding earnings between now and expiration, positive earnings per share growth to reflect good management. So, and then you can add the other criteria if you use RSI or if you use other things along those lines as well. Let's jump over here real quick. Instead of bull call debit, I'm going to put the bull put credits in from the other strategies menu. It's up here at number 2. All right, so let's go to that weekly bull put search. Oh, it's not there. Okay, there was a stock. It was either UNA or UAN that I used in Sergio's example earlier via email. But let's just take a look at Enphase Energy. Oh, before I do that, I apologize. Yeah, so I'm looking for that MACD positive crossover at least 3 days. Stock above the SMA 20. Probability above the short put of greater than 85%. Minimum 9% return on the position. Some liquidity factors as well. And of course, avoiding earnings between now and expiration for a credit spread position. Let's take a look at Enphase and see what we've got. Now it's a much slower mover, but you can see here, even though we'd say the MACD is negative because it's below the divergence line. We still had a recent crossover, kind of petered out, but didn't quite cross over again. And it's still showing us that trend that we want, and it is now above the SMA 20 in the direction that we wanted to go. Let me try, and you can see here, when it had that recent crossover, well, it's not recent, it's about 3 months ago, but at this point, the stock dropped below the SMA 20 of negative crossover. That's something I would have considered for a bear call credit spread. That's one of the default filters that would be used there. Is it every stock? No. News can come out, sudden surprises, things of that nature, and they can throw a wrench into the loophole, for lack of a better term. That analogy is terrible. It doesn't make any sense, but you know what I mean. They can throw a wrench in your trading plans, your trading engine. Let me see if it was UNA or UAN. I forget which one it was. But I saw this morning, right before the market opened. This is not the one I was looking at. So let's try UAN, something like that. That's the one. Okay, so this is the one that sort of broke the rules, and it's because I believe earnings came out today before the market, and that's why we saw that sudden drop, if I'm not mistaken. But in most cases, you can see here, this is what I brought up to Sergio related to the MACD. He had asked, when you say that you want the MACD positive crossover, do you mean above the divergence line, or do you just mean across over the signal line? Well, normally what I see and what I look for in the bullish strategies is a positive MACD crossover here as the stock is moving above the SMA 20. That'd be a good time for a bullish trade. Well, what about here? Well, now I dropped below the SMA 20 and I had a negative crossover. This is where I would have stopped out any bullish positions I had here, or maybe converted a bull put credit spread to a bear call. And then at this point here, flirting with the SMA 20, I probably honestly would have done it here. Now it's above the SMA 20 and I have that positive crossover and it did what I wanted, but then today it had a bottom out. But still 8-9 points above where I would have entered the trade in the position. Now, as I explained in that email to Sergio, and I said at the end, this is what has worked for me personally with the bull put credit spreads and back-tested results from, back-test results, Richard, and paper trading and real trades, developing the system same as Ernie did for the picks of the day. I tried different variations of Bollinger Bands, RSI, and MACD, and those default criteria in the bull put were what I found matched my criteria for the goals set for the strategy in the smaller portion of my portfolio. You should never trade credit spreads with maybe more than 10 to 20% of your total portfolio value, because it will decline 50% at one point or another. Okay? But that's to meet my targets. That's to meet my goals. Might not be your goals as well, but I definitely think that, yes, I do not want to enter a neutral to bullish position. Covered call, cash secured naked put, bull call debit spread, bull put credit spread, calendar call spread on a stock that's below its 20-day or 50-day moving average and has a negative MACD and has been declining. I don't bottom feed. We've run different tests on that for stock purchase, trying to bottom feed on stocks or stocks that look like they're having a bottoming Bollinger Band, thinking that that's the best time to get in and they move back up. And it's not consistent. Sometimes it works great. Sometimes it does not work well at all. And that's a little bit of difficult. So Richard, in our opinion, Ernie's opinion, my opinion, the opinion here at Power Options, we will follow the trend when entering the positions that match the sentiment for the strategy. And when the trend ends, we'll look to manage, close, or adjust, following the different rules we have for those strategies as well. Okay, so it's kind of two discussions there, the one for Lynn and then the one for Richard there related to the trend, where we pointed out some of the things we were looking for Sergio. And even though the example I gave him today bottomed out, as we saw with UAN, Deere is another one. That's a good look. We know that that's been depressed recently. But look, there you see that crossover again. Right there for Deere. And that was near the bottom. And once it went above the 20-day moving average, yeah, had a little dip there, but it started to move back up in price. That negative crossover, you can see it here at this point. And some hesitation, but then some declines. Started to come back up. You got to watch. This is important. You got to watch sort of the false signals there. Give it some time, because then we're just sort of down, down, and down again.